How did national income accounting define macroeconomics? Imagine trying to understand how a whole country is doing economically. You wouldn't look at just one business or one person. Instead, you'd want a big picture view. That's where national income accounting comes in. It helps us measure and understand the total economic activity of a nation over a specific period. It's like taking a giant snapshot of everything produced, earned, and spent across the country. This approach is the foundation of macroeconomics, which looks at the economy as a whole instead of individual markets or people. National income accounting calculates key totals like gross domestic product, or GDP. This number shows the total value of all final goods and services produced inside a country during a certain time. It's expressed in money terms so we can compare different types of products easily. For example, if a country makes cars, bread, and computers, GDP adds up the value of all these items to give us a clear idea of how big and active the economy is. Another important measure is gross national product, or GNP. This includes the value of goods and services made by a country's citizens, whether inside the country or abroad. Net national product, or NNP, takes GNP and subtracts depreciation, which is the wear and tear on capital goods like factories and machines. These totals help economists see how well the economy is performing over time. The core formula used in national income accounting is simple but powerful. It says that total income or output, called Y, equals what people spend on goods and services, which is C4 consumption, plus I4 investments made by businesses, G4 government spending, and the difference between exports and imports, X minus M. This equation links how much is produced and how much is spent, showing the flow of money in the economy. From a macroeconomic point of view, national income accounting helps us understand overall economic health. It shows whether the economy is growing or shrinking, if inflation is rising, or if unemployment might be increasing. It's the main tool used to analyze broad trends, guide government policies, and forecast future economic conditions. Practically, policymakers look at GDP growth rates to see if the economy is expanding. They monitor price indices like the GDP deflator to check for inflation. And they use this data to decide on things like interest rates, government spending, or taxes. So, in simple terms, national income accounting gives us the numbers that define the big picture of how a country's economy is doing. It's the starting point for understanding macroeconomics and making informed decisions about the future.